Welcome back. Now, don't be so quick to switch funds. According to Momentum's latest sci-fi report, switching results in more than 3% in lost returns per annum. And while this seems like a small price to pay, to put it into perspective, investors on the Momentum Wealth platform lost roughly 60 million rand last year due to the behavior tax. Paul Nixon, head of behavioral finance at Momentum, joins us with more insight. Paul, thanks so much for your time this afternoon. And I think we should start right there, just explaining the concept of behavior tax.
Yeah, very good. Thank you very much for having me. And good afternoon to everyone. So behavior tax is simply, so if we can put it in simple terms, if you're invested in Fund A and for whatever reason you decide to move that money to Fund B, we carry on tracking the performance of Fund A, and obviously if the fund that you've moved to performs worse than the fund that you were in, it's then recorded as a behavior tax. So it's a lower investment return as a result of your behavior.
Now, looking at the report, we do notice that there is a steady ease when it comes to the losses connected to behavior tax from 2022 to 2023. What had initially sparked the trend of switching funds?
Yeah, so look, apparently what's actually really led to this very sharp acceleration in switching was actually COVID. So we actually saw that even during periods like the GFC, so global financial crisis in 2008, and during subsequent banking crisis, we saw that the behavior tax was always around about 1 to 1.5% over a long period of time. Since COVID, that's doubled. So it seems that the kind of level of engagement that people have with their portfolios, so people obviously, because we didn't have a lot to do, we stared at our screens a lot more, so we checked our portfolio balances a lot more. And this increased engagement that we have with our investments led to inevitably people moving money around and unfortunately losing money along the way. So it seems that this, this digital or increased digital adoption, rather, that COVID sort of almost caused or led to, has also had an unintended consequence of people, becoming more engaged with their portfolios, moving money around a lot more, trying to do stuff, and that results in lower investment returns.
You mentioned something interesting there around how when people had a bit more time on their hands and they were staring at the screen, that's when we saw the uptick in, the switch in funds. And I guess maybe that's why we're seeing people that are retired doing this as well, because they do have more time on their hands. But isn't this concerning, considering that they do have less time to recover those funds that are lost?
Absolutely, and that's been one of the most interesting discoveries, I think, from when we start to delve into the different, investment products that people in, so are they is it discretionary money, so people are just investing in unit trust, for example, versus compulsory money, which is people in retirement who have already retired but are exposing their retirement capital to markets. And it seems that that's one of the big effects. When people retire, they become more engaged with their portfolios. Their income might not be linked directly to the market, but their capital values are linked to the market, which means obviously their money will run up sooner if the market returns less, which means that they're more susceptible to this. So they're tracking that value. They need to be exposed to risky assets because obviously we're living longer these days.
Yeah.
But unfortunately, people don't have the psychological resilience to necessarily withstand the ups and downs that markets have. So that also gives us some interesting insights as well into certain types of people, and perhaps some people who don't have that resilience should perhaps look at increasing or allocating a larger portion of their retirement capital to guaranteed products, where their income is actually guaranteed and they don't have to worry about market fluctuations, because certainly it seems that a lot of us can't handle them.
Paul, is this an issue of not getting enough information or not knowing where to put funds or put your money?
I think it's too much information, to be honest. I think there's so much information around there. Whatever your view, I mean, COVID actually brought this out as well, right? So whatever your view was, if you believe that vaccines were a scam or you believe that vaccines were the savior, whatever your view was, you would find information to support that from a supposed scientist, right? So the problem is, whatever your view is, you can find information out there to support that view. So if you think the market's going to crash or there's a bubble in the S&P, you will find a very, very smart group of people who will support that view. If you believe that the market's going to run for another 3 years, you will again find a smart group of people that are going to support that view. So this really just tells us that markets, or shows us that markets are random. It doesn't matter who you are. You can't predict where the market's going to go. It doesn't matter how smart you are. Warren Buffett doesn't know. A lot of people don't know. So you've got to kind of hedge your bets and diversify your portfolio to spread that risk around. But I think that the big information, or the big trap here, is too much information. Investors sometimes don't know where to turn. They're getting information from WhatsApp groups, from Facebook, from news channels, from supposed experts, and I think it's information overload. And sometimes we just need to kind of keep it simple.
Yeah. Paul, you also mention the different, or rather list different types of investors, and I'd just like you to just zoom in on the behavior you're seeing there, just your analysis on that.
Yeah, so we used some machine learning techniques to analyze or to figure out if there weren't any patterns of behavior. So, where there's a pattern in behavior, it means that we can start to intervene and try and help people when we think they're going to make a bad decision, for example. So what the algorithms or the machine learning actually revealed was that there's around about 4 consistent patterns that people tend to do, or switchers tend to do in sort of making their decisions. The first one is some investors are naturally quite aggressive or assertive, so they tend to chase past performance quite hard, right? So they're looking for that next big thing. They're looking for big performing stuff, right? So things like cryptocurrencies, or things like private equity, or things like hedge funds, right? They're really, really after that. Then there's the opposite of that, which are the more anxious investors. So they don't mind taking risk, but at the first sign of market turbulence, they'll move their money to safety, right? So those are the anxious investors. Then you get the market timers, who are a combination of the first two, right? So when markets are running, so they're greedy when others are greedy, and they're fearful when others are fearful, and they actually switch the most. And then the last one is the avoiders, people who just don't take enough risk. And that's also an issue, by the way, because if you, especially in retirement, you've got 30 or 40 years to live. If you're not taking enough risk, it means that your money is going to underperform inflation over a longer period of time. So those are the 4 patterns, and each of them carry with them different sort of risks, right? But the group that incurs the most behavior taxes is no surprise. It's the market timers. So this group of people tend to lose money on both legs. So when they're greedy, when others are greedy, they tend to incur a behavior tax, but then they also incur a behavior tax when others are fearful as well. So they kind of tend to lose twice.
And I guess this report also just highlighting the importance of having a financial advisor to actually assist you when allocating funds.
Absolutely. I mean, I think it's an extremely good point. So it's very, very important, especially when we look at the psychology of investing as well, that we know that when our money is on the line, when we see those big red numbers on a screen, when our emotions take over, we actually lose access to our prefrontal cortex. So even from a biology point of view, what happens, and they've shown this, by the way, when people have cortisol in their bloodstream, so that basically is your stress chemical. So when you undergo that stress response, you see that big red number on a screen, cortisol gets released into your bloodstream, and you actually lose access to your prefrontal cortex, right? And that's a biological function, it's forcing you into that fight or flight situation. And if you make a decision under those circumstances without your logical thinking center, you're probably going to make the wrong one. So it's very, very important that you have access to someone to advise you who is not in that sort of emotive state. And that goes to show you that 3% behavior tax is that's the value a financial advisor can add if you've picked the right one, by the way, because if your financial advisor is telling you to switch, then that's the wrong financial advisor. You need to pick the right financial advisor, and that's also why that's so important.
Paul, thanks so much for your time and just sharing insights from that report. That was Momentum's head of behavioral finance, Paul Nixon.